I made these two changes to my client's portfolio that helped her go from $100,000 to almost $500,000 in 5 years. I call these two the portfolio profit killers. Over the next few minutes, I'm going to show you what those profit killers are and how you can fix that problem right now. And I'm going to hook you up with this free profit killers worksheet that will show you what a huge difference if you make these minor changes right now that will help your investment portfolio grow faster so you could potentially retire earlier or just retire with more money, like substantially more money. Just comment below worksheet and I'll DM you the link. No email or any sort of option required. My gift to you for watching this video. For those of you who don't know me, my name is Michelle Hung. I'm the author of Investing for Teens, How to Save, Invest, and Grow Money. And I am a fee-only financial planner. I've taught thousands of people how to plan for their financial future and invest in the stock markets to build a lifetime of wealth. I've been seeing the most common mistake over and over again, and that is these two profit killers lingering in people's portfolios that are costing them well over $250,000 by the time they retire. But don't worry, I'm going to show you how you can fix it in this video so you can start earning the returns that you deserve. The first profit killer is high cost mutual fund fees. Canadians pay one of the highest mutual fund fees in the world, in addition to high cost of housing, cell phone bills, airline services, postal services. Our cost of living is high enough as it is. Let's not add another one to our list. The average mutual fund fee in Canada is around 2.3%. Now, it may not sound like it's a lot, but it is, considering there are alternatives out there for a fraction of the cost, like 0.3%. And you can get those by investing in exchange traded funds, ETFs. These things are like mutual funds, just a lot cheaper. Everyone is more or less invested in the same thing, okay? There are only so many companies out there for us to invest in. So why pay more for it? For example, when you're investing in Canadian companies, we're going to be investing in all the big bank stocks like RBC, TD, Scotia, BMO, CIBC. We have 3 telecom companies, Rogers, Bell, Telus. We have our tech darling, Shopify. A lot of banks offer ETF alternatives, but they're not really pushing for that out there because they don't make as much money off of those. You'll have to ask for it. And for every mutual fund out there, you can replicate it easily with an ETF. And actually, I'm going to give away another bonus in this video. If you want to know how to turn your money-sucking mutual funds into a winning ETF portfolio, comment winning below and I'll hook you up with another free cheat sheet on how to do that. The second profit killer is not taking enough risk with your investments. That means you're in balanced funds or conservative income funds, and you're like 20 or 30 years out from retirement. Not taking enough risk is another risk in itself because you are selling yourself short on hundreds of thousands of dollars in returns on top of being in expensive mutual funds. Your money is being invested anyway. You're not touching it for a long time. So you might as well maximize the risk so you can maximize your returns. Now, don't get me wrong. We're not talking about putting your money in super high risk investments that'll cause your money to go to zero. Okay, these are calculated risks that you are taking by staying diversified and investing in hundreds, even thousands of companies across the board so that your money doesn't go to zero. Yes, you will experience volatility in the short run. That means price fluctuations, stock market fluctuations, but that doesn't matter because your focus is on long-term results. And if you stay invested, focus on the long-term results, you will be rewarded handsomely. And it's enough to get you over the finish line for your financial goals like retirement or paying for your kids' education. And if you look at the funds that are considered aggressive, they actually still hold a medium risk rating. So to maximize your returns on your investments, you want to make sure you're invested mostly, if not all, in equities. You do this by shifting your investments out of these balanced and conservative funds into all equity aggressive funds. If you're in retirement or nearing retirement, of course, that's a different story. But if you're decades out before you need this money, don't be afraid to maximize your risk. It pays off in the long run, so long as you stay invested, no matter what happens. If you want to see what these two profit killers are costing you, comment below worksheets. And if you want an additional bonus worksheet on how to turn your money-sucking mutual funds into a winning ETF portfolio, comment below winning, and I'll hook you up with that worksheet as well. Again, no email or opt-in required. My gift to you for watching this video.